The last time we saw our next guest, he told us it's Amazon and Walmart's world, and we are just living in it. Well, he's heard from more than a dozen retailers since then and says despite broad inventory normalization and some improvement in margins, retailers of all stripes are still striking a cautious tone heading into next year. But one stood out among the pack, Five Below. That was the mystery chart we teased just a moment ago. Joining us with his takeaways from the Morgan Stanley Global Consumer and Retail Conference's analyst, Simeon Gutman. Simeon, welcome. Good to have you with us.
Thanks for having me, Tyler.
You still like Amazon and Walmart? Do you think they're still just the big gorillas in this marketplace?
Yeah, the message on that last week was that in an e-commerce world, there's two behemoths taking most of the share, and that leaves crumbs for everybody else. That's the e-commerce side of it. I follow Walmart, and they seem to be the big winner in that regard. If e-commerce continues to take share at the pace of at the expense of brick and mortar, then yeah, that's where the top line seems to be growing. Five Below is a little different story. And by the way, thanks for the dozen companies. We had 17 of our retailers there. Five Below is a little different because they seem to be in their own lane. They're controlling their own destiny. I know we've heard from toy makers that the toy environment is tough, but Five Below has creative merchandising that drives traffic into their stores, and they should be able to grow closer to their normal algorithmic growth, which is pretty good, mid to high teens EPS growth.
Yeah. I want to come back to, I want to get a little more on Five Below in just a moment, but I don't want to leave Amazon and Walmart. In that e-commerce space, isn't Walmart a somewhat distant second to Amazon?
They are. Mathematically, Amazon probably has 30-40% of e-commerce market share. Walmart's probably 6%. Mm-hmm. If you look at the total revenue pool, Walmart still has a bigger overall share of U.S. consumer spending.
Right.
So now Amazon's doing that all online. Walmart is not too shabby. Look, Walmart's many years behind in that regard, and that's what they're catching up on. At first, they went at it with a 1P approach, and that proved to be maybe too narrow of a focus. And now they've expanded to third party. They have forward positioned inventory. They're put a seller summit in September. So they've put a big emphasis in adding the marketplace. And I'm not sure Amazon feels their footsteps, but I think they can be heard now.
It seems that an undercurrent of the 17 companies is that they're expecting consumers to become a little bit more cautious, though Five Below, constructive on holiday and momentum, stable positive margin outlook, new format stores, shrink recovery expected to take more than a year, input cost deflation. That's a pretty good sign from Five Below. So are they the outlier here?
Yeah, and just to get to your first point on the consumer sounding cautious, I'd say a year ago the tone was probably more optimistic, and that proved to be too aggressive, too optimistic. As we look now, the companies in somewhat are capitulating the realities of this tough backdrop, discretionary spend under pressure, durable good units negative, many companies comping negative. So companies were much more sobering about the backdrop. That was the tentativeness. Five Below stands out because they sell value. They sell discounted product across multiple product categories, right? They're an amalgamation of an off-pricer and of a discount store. And their merchandising is working. Their traffic is growing. Their same-store sales are up. And they are almost insulated from all the noise that's happening outside. And so if you're looking across the space in which demand looks pretty tough and what you called out earlier, which was margins look to be one of the only bright spots, this company has the full P&L working for itself in 2024.